From the Mac and iPad to the Vision Pro, retail prices for consumer hardware are moving in one direction. To maintain standard profit margins, manufacturers are having to account for a sharp rise in the cost of the components hidden inside these devices. To manage these costs, Apple typically relies on a specific supply chain tactic. When a primary vendor raises prices, Apple introduces a secondary or tertiary supplier into the network, using that competition to force a lower contract rate. Following this playbook, Apple recently commenced formal qualification tests for memory chips produced by two major Chinese state-backed firms, Changxing and Yangtze Memory Technologies. It was a routine corporate procurement move, but it pushed a trillion-dollar company into a direct geopolitical standoff with the United States government. This friction began with an explosion of investment in generative AI infrastructure. Hyperscale cloud providers are currently spending hundreds of billions of dollars to build out data center campuses. Manufacturing capacity has shifted. Leading memory producers reallocated silicon away from consumer electronics toward high-margin memory for AI accelerators. With fabrication lines busy feeding this AI boom, conventional memory contract prices surged by roughly 60% in a single quarter. While tech firms previously focused on software growth, current hardware requirements have triggered a capital-intensive spending cycle that market analysts project will persist through at least 2027. The immense capital requirements of the AI build-out have altered the unit economics of semiconductor fabrication. For a consumer electronics company, securing a steady volume of high-density memory has shifted from a routine negotiation into an operational hurdle. When Apple looked to Chinese suppliers to solve this price crunch, their strategy ran into the technical realities of manufacturing silicon under international trade restrictions. Because of U.S. export controls, Chinese fabs cannot acquire advanced extreme ultraviolet lithography machines. Instead, they have to rely on older deep ultraviolet equipment to produce their chips. This creates a major efficiency gap. Using older tools to achieve the same silicon output requires roughly 30% more wafer starts, adding significant baseline production costs. This inefficiency makes it difficult for a firm like Changxing to offer a price low enough to undercut established South Korean suppliers. There is a rigid cost floor they simply cannot drop below. Furthermore, what little capacity they did have was already absorbed. Domestic Chinese brands like Huawei and ByteDance have already secured the available supply under high-price contracts. Since the Chinese suppliers couldn't provide a surplus or a discount, Apple lost its leverage. Incumbent vendors like Samsung and SK Hynix kept prices high and continued to prioritize their enterprise AI clients. While the technical front stalled, the procurement plan also ran into a web of national security regulations and trade policy in Washington. Typically, export controls prevent American companies from sharing custom design specifications or engineering blueprints with state-backed Chinese firms on the federal entity list. To bypass these rules, Apple focused on standardized commodity memory. Because these off-the-shelf components require no custom engineering or IP transfer, the purchase does not trigger a mandatory federal regulatory review. Since Apple's move was technically legal under current law, Commerce Secretary Howard Lutnick had to rely on a public pressure campaign rather than statutory enforcement to stop the deal. This gap between trade law and geopolitical goals transformed a standard component audit into a high-profile political fight. This conflict gave domestic manufacturers an opening. Idaho-based Micron Technology began aggressively lobbying the White House to block Apple's sourcing plans. Micron argued that allowing Apple to route billions of dollars to Chinese fabs would directly undermine the U.S. CHIPS Act, which is currently backing $250 billion in domestic manufacturing investments. A bipartisan coalition in the Senate soon followed, delivering a formal demand to Tim Cook. They called for a complete global exclusion of these Chinese components from Apple's supply chain. The letter established a hard deadline of August 21, 2026. By that date, Apple must formally commit to excluding these suppliers or face legislative retaliation. The ultimatum pits a tech company trying to insulate consumers from price hikes against a government trying to protect its capital-intensive domestic semiconductor industry. If Apple complies with Washington, they will have to absorb the higher memory costs driven by the AI boom. If they resist, they risk severe federal sanctions. To survive, manufacturers will adopt a dual supply chain model. One enclosed loop uses Chinese semiconductors strictly for hardware sold inside China. A separate, more expensive line serves international markets. This satisfies security mandates but duplicates testing and fractures inventory, destroying economies of scale. This marks the conclusion of the cost-optimized, borderless tech supply chain that has defined the industry for 2 decades. As the flow of silicon becomes a matter of national policy, the strategy of the government, not the efficiency of the factory, now dictates how consumer technology is built.